Most funds today specialize in certain industries or sectors to maximize returns. My next guest does the opposite with success. Her Allspring Diversified Capital Fund is a go-anywhere fund that can invest in everything from blue chips to small industrials to bonds, and it's outperformed 99% of its peers over the past 15 years. She says flexibility is at the heart of her winning strategy. So what are we buying now? Let's ask Margaret Patel, Senior Portfolio Manager for Multi-Asset Solutions at Allspring, as mentioned. Margie, welcome.
Thanks.
Before we kind of dive into all of this, do you have a reaction to the jobs number today and your kind of sense of the economic landscape and the sort of prospects for Fed action for the next couple of months?
Well, once again, we've had a surprisingly strong number. Second quarter, third quarters were surprisingly strong. I think we'll see the same thing in the fourth quarter. And it really shows the resilience of the economy and, frankly, that it is relatively insensitive to the moves of the Federal Reserve. There's not enough over leverage in the system, in my opinion, with consumers and business, that there really is that much sensitivity to the Fed making these little changes. So I think they're a little flummoxed because the market really hasn't done, or the economy or inflation, what they thought would happen, depending on how they've moved rates from basically 0 to over 5% in the funds. It just hasn't happened.
Yeah, it's amazing. It really is. You see growth next year may be more muted than this year, but still strong enough to support high single-digit to low double-digit returns from stocks. And as mentioned, you know, you can kind of do a lot of different things in terms of stock picking here for where you see value. What are the things kind of leading the charge for you right now, the best opportunity?
Well, I think in general, areas of the market that have growth are going to continue to be leaders, just as they did this year. There's a lot of hope, I think, by everybody's part, really, that the market broadens out and isn't just a handful of stocks driving the market. But frankly, I think the broadening out is going to be rather limited. I think it's still going to be limited to those large cap stocks that have proven growth, very high quality balance sheets. And the broadening out is going to be really very selective. We think in the industrial sector, technology, some of the names that didn't get chosen, and maybe a little turnaround in healthcare. But basically, we think it's going to be more of the same, a little bit more broadening out and a little slower, simply because we had such a tidal wave of money, deficit spending that lifted the economy over the last year as a reaction to COVID and so forth. And that money's pretty much been played out. So we think we're looking for slower growth in the first quarter. And then I think in half of the year, typical election year, we'll see a big bounce up.
Couple moves you made that have helped your outperformance this year. One was you really pulled back on healthcare, which became a pretty crowded consensus thing and has, of course, underperformed. That was a help. You also were more into tech, moving more heavily into tech about a year ago. What told you that those two moves were the right moves at the time to make?
Well, the main thing was feeling that the economy was not vulnerable, that these interest rate moves were not going to hurt the economy, bring on a recession. If you remember, a year ago, most people were thinking we would have a recession in 23, and we simply haven't. It's nowhere in sight. So we thought economic growth would continue in defensive names like healthcare, especially because healthcare had a lot of roll-up of revenues, COVID-related, and also we're seeing a slowdown in demand really pretty much across the board outside of the U.S., particularly in emerging markets in healthcare. So we thought that it was better to be more in economically sensitive areas, that the defensive areas had individual problems, and we didn't think that they were going to outperform.
Yeah, so then looking at your holdings right now, if I'm not mistaken, biggest holdings include Broadcom, Alphabet, AMD. You got Leidos in there, Microsoft, Marvell, Adobe, Motorola. So should we expect a lot of changes for you for 2024, or is that a good snapshot of where you think investors should be positioned?
I really think those are the names that are going to carry through next year. I love to look at undervalued stocks, and certainly we've looked at all those sectors that haven't really participated. They look cheap, but a lot of those companies have problems. Either they have slow demand, they're commoditized, they're dependent on growth from China, which isn't happening. And so we really think you have to look at those sectors such as technology, some of the industrial related, to really drive the market next year.
And quick final question on bonds. Walk us through your thinking there and where you're kind of out of step with the market.
Well, I think that the bond market is almost irrelevant to the stock market, and Fed moves are really not very relevant to what equities are going to do next year. I think the 10-year in a 4.25, 5.25 even range will be just fine for equity markets. I do think high yield will continue to outperform. One of the conventional wisdom was you want to go for quality in bonds. Turned out you wanted to be in high yield, and I think that'll still be the case. Economically sensitive bonds in high yield will continue to outperform.